Here's what you need to know about the Ripple case that was just decided, the case brought by the SEC against Ripple regarding its XRP token. So just yesterday, July 13th, the district court out in New York issued an opinion. So let me show you a copy. All right, so as you can see, the price of Ripple or XRP tokens dropped off substantially over the last 2 years, year and a half, as the SEC has gone after Ripple for the sale of its XRP tokens as an unregistered security, sale of a security. So here is the case, the opinion that was filed yesterday. And essentially, it's based on a motion for summary judgment, meaning they don't have to go to a jury because the facts are essentially not in dispute. And basically, it's a matter of law. So the judge went through all the different claims and made various rulings. Now, on the news, you'll hear, Ripple won or the SEC won. They both won to some extent. And does it mean that everything is clear for crypto in the future on how to basically move forward? Provides a little guidance, but this is not necessarily the end all and be all for crypto to say this is how things are going to be going forward. Plus, the SEC could appeal, or the other side could appeal, Ripple. So let's go take a look. Essentially, we're looking at the Howey test again, which is whether it's an investment contract, which would be essentially a security that the SEC can regulate. So it goes over the background of the case and it separates it out in the different types of sales of the XRP token that were done. So first, XRP was sold to institutional buyers. Now, this was found to be unlawful, an unregistered sale of a security. It was found to be a security based on written contracts with institutional buyers where they sold XRP. And essentially, the court just says that the third prong of Howey, the Howey test, looking at the economic realities around those sales, those buyers had a reasonable expectation of profits that was to be derived from the efforts of others, which is the third prong of the Howey test. They said that was clearly met based on the facts. They invested money, there was written contracts, there was standard investment terms, and they were expecting a profit based on the effort of others. And the court looked at all the circumstances and essentially said that both the communication, marketing campaign, the way that those sales took place, most investors would understand that the money they were putting in for those institutional sales were, basically expectation of profit. And so this was a security. So the SEC won on that point when it came to an unregistered sale of securities to those institutional buyers for several $100 million that was raised. The second part is programmatic sales. These are ones that were basically blind bid-ask transactions where they're selling XRP on a digital exchange as a digital asset, as a cryptocurrency. So the people who were buying it didn't necessarily know who they were buying it from because it was a blind bid-ask procedure. And they weren't really necessarily, well, let's take a look at what the court says. Having considered the economic reality of programmatic sales, the court concludes that the undisputed record does not establish the third prong of the Howey test. The institutional buyers expected that they were going to increase the value of XRP, but the programmatic buyers did not expect necessarily the same, or at least the facts can't support that. They're blind bid-ask transactions where the buyer doesn't know that they're necessarily investing in Ripple or XRP and that money is going to be used and they're going to get a profit from the work of someone else, and essentially Ripple. So the court also talks about they may have had an expectation of profit, but they didn't necessarily get that from Ripple's efforts because they didn't know who they were buying it from. They wanted to make a profit on it, but they weren't buying it. They didn't know if they were buying it from Ripple directly or who they were buying it from or what was going to happen on it because it was a blind bid-ask procedure. So the inquiry is an objective one focusing on the promises and offers made to investors. It's not to look at the motivation of the individual participant. So as an investor, was Ripple making an offer to sell a security? No, it was a blind bid ask. The investor who put money in, or the people who bought it, didn't necessarily know. They didn't consider themselves investors in Ripple. So the court says essentially, no. After looking at all the facts, those programmatic sales of XRP were not an offer and sale. It's not an unregistered sale of security. So Ripple won on that part. There were some other distributions of XRP to employees and consultants, essentially paying them in XRP instead of paying them cash. The court did find that these also were not an investment of money because the people who got them were not putting their own money in with an expectation of profit. They were just getting XRP as consideration for the work they were doing. So Ripple won on that one as well. That was not an unregistered sale of a security. So two of the executive officers, their offers and sales were also done through the blind bid ask transaction. So just like the programmatic, these were found to not be an unregistered sale of security. There was also an argument that basically in crypto, the whole argument has been that there's no fair notice or due process because we don't know if crypto is going to be a security, or what the regulations are going to be yet. So how can you come after us later and say we did something wrong when it wasn't clear that we were doing anything wrong? The court kind of quashes this and doesn't really get into it too much, but they don't think that there is a fair notice defense that you can use. So basically, in crypto cases, you usually can't say, I didn't know. Like, you didn't tell me this was going to be against the law, and I didn't know. Like a lot of people, including their counsel, who provided an opinion 10 years ago that some of this, what they're doing, could likely be considered a security which would be regulated by the SEC. And their attorneys they hired told them this like 10 years ago or something. So there was notice, and that's not a valid argument, essentially. The court goes through a little bit of some other issues, but essentially that's the case. So don't necessarily read the headlines and think that, oh, crypto's golden now. It still comes down to the facts of what's being done with those tokens or those cryptocurrencies. It still could be considered an unregistered sale of a security depending upon what you're doing with it. Thanks for watching.